Brad Williams, Frugal Finance. Let's talk currencies. Forward and future contracts on currencies. Pretty much going down the same path over and over and over again. We're changing instruments, but the tools will pretty much can be the same. Forward and future contracts on currencies are agreements to buy or sell a specific amount of foreign currency at a predetermined price at a future date. When we talk about these contracts, we need to understand two important prices: the spot price and the forward or futures price. The spot price is the current price of 1 unit of the foreign currency in terms of US dollars. Forward or futures price is the price at which you agree to buy or sell the currency in the future. Why does this matter? Well, because currencies can earn interest. If you hold a foreign currency, you can invest it and earn interest in that currency. For example, if you have euros, you can invest them in a European bond and earn interest in euros. Here, where it gets interesting, there's something called interest rate parity. This is a rule that says if you convert currency now or in the future, the amount you get should be the same either way. There's no opportunities to make free money arbitrage. I think I've been saying this time and time again. Let's say you have 1,000 units of a foreign currency. You can either invest it in that currency and then use a forward contract to convert it to dollars later, or you convert it to dollars now and invest it in US dollars. The interest rate parity formula tells us that the forward price equals the spot price multiplied by the ratio of the interest rates in the two currencies, raised to the power of time. So, if the interest rate in the foreign currency is higher, forward price will be higher than the spot price and vice versa. To make this clearer, let's look at an example. Suppose you have Australian dollars and you want to convert them to US dollars in 2 years. If the forward rate you calculate using the interest rate parity formula is different from the actual forward rate in the market, you can make risk-free profit through arbitrage. When you hold a foreign currency, you have the advantage of potentially earning interest at the risk-free interest rate offered in that particular foreign currency. For example, a holder can invest the currency in a foreign denominated bond. We define R of X as the value of the foreign risk-free rate when money is invested for time T. The variable R, the US dollar risk-free rate when money is invested for this period of time. The relationship between F and O and S of O is F of O, forward or futures, is equal to the price times EXP, R minus R of X to T. This is the well-known interest rate parity relationship from international finance. Let's say an individual starts with 1,000 units of the foreign currency. There are two ways it can be converted to dollars at time T. One, by investing it for T years at R of X and entering into a forward contract to sell the proceeds for dollars at the time T. This generates 1,000 times EXP R of X times T times F of O, dollars. The other is by exchanging the foreign currency for dollars in the spot market and investing the proceeds for T years at R. This generates 1,000 times S of O times EXP R times T dollars. In the absence of arbitrage, the two strategies must give the same result. Hence, 1,000 EXP R of X times T times F of O is equal to 1,000 times S of O EXP R of T. So that F of O is equal to S of O EXP R minus R of X times T. Suppose that the 2-year interest rate in Australia and the United States are 5% and 7% respectively, and the spot exchange rate between the Australian dollar and the US dollar is 0.620 US dollar per Australian dollar. Therefore, F of O is equal to S times EXP R minus R of T, T. The 2-year forward exchange rate should be 0.62 times EXP 7 minus 5 times 2 equals 0.6453. The 2-year forward exchange rate. Remember, Our current spot rate looks like it's 0.62. The 2-year forward exchange rate is 0.6453. Let's say first that the 2-year forward exchange rate is less than this, say 63. An arbitrager can borrow 1,000 Australian dollars at 5% per annum for 2 years, convert to 620 US dollar and invest US at 7%. Both rates are continuously compounded. Enter into a forward contract to buy 101.0517 times 0.63 equals 696.26 US dollars, e.g. 1,000 times EXP 5 times 2 equals 110517. The 620 US dollars that are invested at 7% grow to 620 or 713.17 US dollars in 2 years. Of this, 696.26, 1105.17 times 0.63 are used to purchase 11,017.63 conversion to buy Australian dollars, so 0.63 conversion, under the terms of the forward contract. This is exactly enough to repay principal and interest on $1,000 Australian dollar that are borrowed. 1,000 EXP equals 1105. This approach thus gives us rise to riskless profit of 713 minus 696 equals 1619 US dollars. Try this with 100 million Australian. Let's say next that the 2-year forward rate is 0.660, greater than the 0.6453 value given by forwards equals price times this continuous compounding. An arbitrager can borrow 1,000 US dollar at 7% per annum for 2 years, convert to 1612.90 Australian, and invest the Australian dollars at 5%. Enter to a forward contract to sell 1783.53 times 0.66 equals 17,647 US dollars, e.g. 1612.90 EXP 05 times 2 equals 1782.53. The initial investment of 1619 Australian, growing at a rate of 5% over 2 years, would yield 1782 Australian. Through the forward contract, the amount is converted to 1176.47. The amount needed to pay off the U.S. borrowing is 1,000 EXP 7.2 equals 1150 US dollars. This approach thus gives rise to riskless profit of 1176.47 minus 1150.27 equals 2620. Now, how would you recognize this? If you're on the currency desk and you're trading dollar to Australian, you're going to see this. If not, maybe you should be trading something else. You're not going to see this big of a change. You're looking at forwards, you're looking at futures, you're looking at change in currency and interest rates. So there's a lot of moving parts here. When you're hired with one of the big banks, they're going to put you through a training program, and they're going to point out some of this stuff, but mostly they're going to tell you, keep an eye on A, B, C, and D, and when there's a variation, now the computers will pick this up, but perhaps not. And that's where you're going to keep this secret. I would, and I would trade this on my own. You can trade off hours, and you can put this trade in somewhere along the line and try to take advantage of this. And I said, you want to keep everything legal and legit. Nothing wrong with you discovering an arbitrage opportunity that's not closed out within multi-seconds and taking advantage of it off hours. Your contract might say something different, but you get the idea. In a world of endless opportunities, this is just one of endless opportunities. Keep in mind, a foreign currency can be regarded as an investment asset paying a known yield. The yield is the risk-free rate of interest in the foreign currency. So yeah, this is pretty complex, period. For you, in order to see this, just explaining it is a challenge, but to recognize it, I applaud you if you can recognize this that easily and be able to act within split seconds. This is the world of arbitrage, and it's pretty nifty, but it's for everyone. Brad Williams, Frugal Finance. How about a little more on forward pricing?